think catastrophe bonds are there to basically provide non-correlated returns. They are, in my view, one of the only instruments out there which are not affected by, let's say, geopolitics, the ongoing Iran conflict that we see, rates volatility to a certain degree, but I come into detail later on. But still, if we look at financial markets in general, if we compare it to high yield, other corporate debt, I think we are still in a very good spot with our current yield of roughly 9% in US dollars. Yeah, that's a very good question. I think catastrophe bonds are there to basically provide non-correlated returns. They are, in my view, one of the only instruments out there which are not affected by, let's say, geopolitics, the ongoing Iran conflict that we see, rates volatility to a certain degree, but I come into detail later on. So fundamentally speaking, what we are doing is we take insurance or reinsurance risk in most cases, and we are basically like an insurance and reinsurance company. Only if a predefined natural catastrophe event happens, we actually have to pay as investors. And if nothing happens, we don't have to pay for it. So if Trump decides all of a sudden to do something in, let's say, Iran, we don't really care about it too much from that financial perspective because our returns are not correlated to these financial markets. Only if this predefined natural event, mostly hurricane risk or earthquake events, happen, only then we need to basically pay. Absolutely. We are not anymore at the levels of premium, so that's what we get for compensation of taking this underlying insurance risk. We are not anymore there where we were 23, 24 and also 22. But still, if we look at financial markets in general, if we compare it to high yield, other corporate debt, I think we are still in a very good spot with our current yield of roughly 9% in US dollar. I think that's still a very strong value proposition, especially if one accounts for the non-correlated nature. Exactly, they're not risk-free, and I think that's a very important point. They cover exactly what I mentioned before, these large natural catastrophes typically, hurricane risk, earthquake risks, but it could be other risks. It could be wildfire risk, severe convective storms. But only if these events happen, only then the capital is at risk. If we have equity volatility, we don't really care too much because that doesn't cause any hurricanes or earthquakes in California. So we are really not correlated to these events. The only risk we have is this underlying reinsurance and insurance risk. That's really the core of the whole strategy in the end. Yeah, the strategy itself, the cat bond strategy for 12 securities is in the area of 6.5 billion. That's our assets that we manage out of roughly 9.5 billion. And our strategy is quite simple from a top-down perspective. We focus on natural catastrophe event and risks. We are not going into other perils such as cyber risks, for example. That's a growing space in the ILS market. There is terror risks, there is other non-correlated risks that is growing in size, but we are really focusing on natural catastrophe risk because we think that's what our investors expect, and I think there we get the most and best risk-adjusted returns in the long run. Our strategy is to try to capture the risks, especially in the US, earthquake risks in California, and as I mentioned before, hurricane risk in Florida. The reason for that is very simple. They pay the best premium, but also have the best model quality. So if we model, for example, hurricanes and earthquake risks, we have a much more certainty around these risks compared to, let's say, we call them secondary perils, wildfire risks, severe convective storm risks, things we read daily in the newspaper, flood events also in Spain, for example, or flood events in general in the UK, or then basically severe convective storms in the US. Yeah, partly. I think our focus is on the peak perils, not because we don't like diversification, but in most cases diversification comes with a lot of model uncertainty. And if our internal models show that it's not worth to take that diversification risk, then we stick to our best paying, best model perils, and that's again US hurricane risk and earthquake risk. There is a diversification. We are not only invested in those perils, but there is an underweight compared to the market simply because most deals that are diversifying are either paying less or are again not that well modeled. Very much climate change is most of the most relevant topics. That's why we actually also earn this very healthy premium at the moment. Without climate change, I think the premiums would be much lower. But what is important, climate change is not our opponent, so to say, because if we can model climate change, and that's mostly the case for hurricane risks, and it's the case obviously for earthquake risk, because there is no impact for climate change, then we are fine to take the risk. It needs to be well compensated, and that's the most important point here. There are, again, secondary perils such as wildfires, where modeling quality and especially climate change has a much bigger impact compared to hurricanes, and that basically makes us more cautious when we invest into those secondary perils. Same for flood events and same for basically hail events and so on. The good thing is that we have very sophisticated models behind it, where we have stochastic analyzations of the portfolio, so we know bottom up, if we put a cat bond into our portfolio, what the risk contribution is, where it's exposed, and that's basically then the job, to have a diversification in the portfolio. So for example, we don't only basically back up insurance companies in Florida, we can diversify with an insurance company that is only active in Texas, one is only active in Louisiana, the other one is more exposed to the Northeast, and that's then the job for the portfolio manager to find the best risk-adjusted return there. And we have proper governance, we have risk management in place that is basically there to observe our liquidity risk in the funds, and that's one of the most important factors why we are in my view successful, because we have this investment process from A to Z in a very governed, institutionalized setup. There is only one risk. I mean, it could be several risks, again, such as hurricanes, earthquake, but underlying fundamental risk in our funds mostly is the natural catastrophe risk. And that's the opportunity as well. We get paid for taking this natural catastrophe risk, and it's not an adverse selection, so we don't get the bad risks from the reinsurance and insurance companies. It's the opposite. They have to cede these risks away because they have too much of these risks on their balance sheet, and that's exactly the opportunity for us as capital market participants to step in, to take those risks and get a healthy premium for it. Most dangerous thing in my view is when it comes to the growth of the market. Growth comes with also, let's say, bad risks. Again, that's an opportunity for us because we can assess if a risk is bad or not. I mentioned the cyber risk, in my view not the most elegant risk we should have in the fund, but that gives us an opportunity, but it's a risk for investors to pick amongst, let's say, the cat bond providers and select the best one, and it's sometimes very difficult for our investors to select this right asset manager in that space. Yeah.